Barry, going back to what you were just saying a minute ago here, when we talk about some of the pressures that we could see on the broader market, you mentioned the fact that Nvidia could be the next Cisco. I'm curious more so why, just given the valuation gaps that we're seeing, it's not exactly an apples to apples comparison. So what is it about Nvidia that you're seeing that makes you a bit worried that this could end up like the next Cisco?
Well, yeah, when I say the next, they're already what Cisco was back in 1999. So they are the largest company. They are the darling. But the valuation difference, consider that semiconductors are capital goods. They're very small, short cycle, early cycle capital goods. They don't typically get an enormous multiple like you would give to a very high ROIC, low incremental cost company like software. Where there's enormous return on capital. Sure, they're getting the build out of AI, but once you build a bridge, you don't need to build it twice. So the build out will not be a continuous process that you can discount over 45 times earnings over 45 years, even with growth. So that's one thing to consider. The other is that if on NVIDIA specifically, it's called the second derivative, the change in the rate of change of analyst EBITDA revisions. That's the thing that we found that guides the stock. So if you look at the year-to-year change of NVIDIA stock, it's the year-to-year change of the revisions in analyst EBITDA estimates. We published a note on this, and that has rolled over decisively 2 quarters ago. So what we think is the stock's year-to-year change will diminish. It'll still be positive, but it looks for a correction, I would say probably in the high 80s by the late third quarter.
And Barry, just lastly here, one of the huge things that we saw with Cisco was a major pullback after the dot-com bubble. Do you anticipate the same type of stock correlation where investors are going to say, okay, who else are they possibly going to sell to? And then you just see a range-bound company for an extended period of time?
No, what happened with Cisco is, and same thing happened to Microsoft and Amgen and a number of other big cap stocks, is their PE multiple was too high and they earned into it over the course of the next 15 years. So the earnings went up dramatically. As was expected. This happened with the Nifty 50 stocks in the early 70s. They earned very well, but their PE multiples were too high. Their PE ratios, the Nifty 50 in the early 70s, if you look that up on Wikipedia or ChatGPT, that if you look it up, you'll see that those companies had these mid-30s, 40s time multiples. They earned into it over the course of a decade. But what we have today is extreme optimism on new technology. Then it was the internet, now it's the AI, narrow markets, increasingly narrow markets with a high valuation. Equity ownership was very high and the day traders and all that. I'm just saying that you have to have been there 25 years ago to remember that it was a very similar feeling environment to today.
I was just opening up my E-Trade account back then, Barry. I was just getting things started. I wish I was around for it.
I was a securities analyst and had been one already for 20 years. And it was, or nearly 20 years. And I covered industrial stocks. And so I was very close to the cyclical world.